Small caps are hot today. Everybody is very excited about it. But are you prepared for the big decline in 2008 that fell by 70% in about 2-3 months?
Hello and welcome to Investors Hangout. This weekly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, nearly 40% returns in the last 3 years. So, had you invested 1 lakh rupees 3 years back, they would have turned over 2.6 lakh rupees by now. Well, that's how an average small cap fund has performed. According to the data released by the Association of Mutual Funds in India, inflows into small cap mutual funds were at a record high in June. Net investments into small cap equity schemes stood at a record high of 5,472 crore rupee inflows. On the contrary, large cap schemes saw an outflow of 2,050 crore rupees during the month. So if you also want to ride this momentum, watch today's episode.
There are broadly two reasons for the small caps going ballistic or proving to be very rewarding in recent times. Every segment of the market, or even the market broadly, is also cyclical. So small caps suffered most in recent past, not very long ago. And there is a reversion to mean. They are making a comeback. That's one. The second is, investors chase performance. If something is doing well, investors pour money. And investors put more money, that in turn drives it higher. Third reason is the very design of small caps. Small sized companies, they have a smaller equity capital. And when more people, assuming that 100 crore rupee has to be invested in stocks. If 100 crore rupee has to be invested in stock and small companies, because the liquidity is lower, because the availability is smaller, they will go up by maybe 3-4 times more than the 100 crore rupee which has to be invested in large companies, because large companies are available in large quantity. They can absorb the kind of flows. So small companies, when a lot of money start chasing them, they go, it's very difficult, too much money chasing too few stocks. So I think it's a combination of these three things, which is driving up the these stocks. But don't feel very happy about it, because the other side of it is that what goes up very dramatically also comes down once in a while. The promise is in the long term. When you look at the long term, and long term meaning, if you look at any 5-year period, the period of, if you invest and hold it for 5 years, the likelihood of losing money in a small cap comes down dramatically. But if you look at 1 year, if you look at 3 months, if you look at 6 months, the likelihood of losing money goes up dramatically, because they can be very disappointing. You can lose and it could be very scary. It could be so dramatic. The fall can be so dramatic. It will become very difficult to stay with these funds. If you invest and it falls by 50% in next to no time, it gets very hard to stay with these small caps. So the promise is that they will prove to be very rewarding. And I think here the mutual funds case becomes even stronger. If you invest in 5 small caps and 3 of them actually go down to zero, you will be in trouble. When you invest in a mutual fund, your money is getting spread over 60, 70, 80 stocks. With some filtration of quality, the fund manager is applying his mind, he is keeping an eye. All those things actually end up reducing your risk substantially. The benefit of diversification, the benefit of professional management is clearly getting demonstrated in small cap. Not as much in large cap, because large cap funds are the actively managed ones. They really struggle to beat the index, but in small cap, they are really showing very impressive numbers. So the promise is that they will prove to be very rewarding in the long run. But the peril is that if you think short term, you will be out of pocket. The lesson from this is very simple. You have to think long term. For equity, one should always be thinking long term. If you're thinking for any period of less than 5 years, you should not even consider equity. So think long term and think of being a regular investor. You can't really invest at one go, because we have seen in case of small cap funds that they are faced with a long phase of zero return. The best performing small cap fund has delivered 28%, little over 28% annualized return over the last 10 years. But This fund also had a period of 3 years in which it gave no return. And generally, that period happens to be you bought it at the high. So the lesson is that never invest at one go. Do your SIP and keep it long term. And this is mandatory for small caps. There is no thumb rule. You should consider anywhere between 20 to 70%. If you have 20 years of investment time frame, if you are comfortable with the massive ups and downs of the market, if you have been a witness to 2008, you can well have 70%. But if you are relatively new to the market, you should have zero allocation to small cap, because it is a function of your experience. It is a function of your investment time frame. If you are investing for 3 years, 5 years time frame, you should not have any small cap. So it's time frame, your risk tolerance, and which is guided by this, your allocation to small cap. But let me forewarn you. When the times are good, we forget that your risk. What is your risk tolerance? We think that we can take all the risk. You have to really look at the worst case scenario, and the worst case scenario is that small cap funds, they lost 70% in 2008. I'm not talking of zero return. I'm talking of from the high to the low. The small cap funds were down 70%. Are you ready for that? If you are not, because your 100 rupee becomes 30, and that could be quite devastating for many investors. And it's a completely different story. Looking at these numbers in the past and listening to a narration of those numbers from me is one part of the story. When your 1 lakh rupees is invested, and if you go to redeem it, and you will be able to get only 30,000 rupees, that's a completely different story. You have to really experience it to be able to feel it. In fact, you should not choose the hottest small cap fund. In fact, you should choose the small cap fund which has the best long term potential. Once you start investing, and once you start investing regularly, it should be in a position to deliver you the best performing returns. And here I would say that Value Research Online could be a very helpful tool for you. Go to Value Research Online, use the fund selector tool, go to choose the small cap category, make a selection of 4-star and 5-star fund, maybe 3, 4 and 5-star fund, because you'll be dropping the duds, or you'll be dropping the relative duds, and look for 15-year SIP return. Long term return, you will get a 15-year SIP return. You will end up with the funds with 15-year history. You will end up with just 5 or 6 of them which are also 3-star, 4-star or 5-star fund. Once you get this list, just choose 1 or 2 based on which fund is managed by the fund manager for the longest period. And if you do this, you will end up with just 2. So choosing a small cap with the best potential by the most experienced manager, which has a demonstrated track record of building great wealth for you over the last 15 years, is you can do it yourself.
Well, that's all we have for you in today's episode. Keep watching the space for more information. If you like the show, do subscribe to our YouTube channel. Take care. Bye for now.